Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar.
Good day, everyone. Welcome to another Cambridge podcast. I'm very excited to be here with you today because finally tax season for 2018 is over. So obviously we had to work very hard. We had a lot of clients that needed assistance in tax planning. So we were pretty efficient this year as compared to other years. So, we're looking forward to moving that needle forward and making certain that we're providing every single benefit and need that our clients maximize on an annual basis. One of the things that I did tell all of the clients that I did tax planning for in 2018 is that there is a major difference between tax preparation and tax planning. Now, today we're going to follow up on the type of things that we're doing on these podcasts on a regular basis. The last 4 weeks we did a podcast on qualified plans. Those are the 401ks, the IRAs, and why they in many ways are a horrible retirement distribution plan. Then we did another podcast on retirement distribution issues and concerns. What are some of the things that are keeping many Americans awake at night when it comes to retirement distribution planning? A couple of weeks ago, we did one on the best preferred retirement distribution plan, which is a 7702 plan, and we talked about the features and benefits of that. And then last week, we spoke and talked a little bit about features and benefits of a Roth IRA. So for that reason, this week, we're going to talk about features and benefits of a Roth 401k, which is an employer-sponsored Roth account. Now, one of the main reasons why I do that, and the next podcast that I'll do next week is going to be dealing with, how to finally divorce the IRS in retirement, and most important, how to do it legally. And the reason why we at Cambridge pay so much attention to making certain that our clients receive as much tax-free income as possible, if not 100% of their income, is because all of the eroding factors that are impacting retirement in the United States today and for many decades moving into the future. Now, what are some of the eroding factors that we have already talked about? Well, the two major ones are taxation and inflation. And we have talked quite a bit about taxation and the fact that, when you look at the national debt in this country, which is now north of $21 trillion, yeah, you heard me right, $21 trillion, and also the unfunded liability for Social Security, Medicare, and Medicare Part D, which is now exceeding $120 trillion. Needless to say, there's a very high probability that the future of taxes is going to be very dim for the vast majority of Americans. Now, I know that we do have the new tax law. The challenge with that is that tax law sunsets in 8 years on the individual side of the house. So January 1st of 2025, everything is going to go back to the old law, as I have said before. Now, obviously, I just heard that, some people in the Democratic Party are talking about if they do win the House, they want to move forward, or the Senate in 2018, they want to move forward to doing away with all those tax cuts and increase revenues. And the only way they're going to be able to increase revenue based on their planning strategy is by raising taxes. So as a financial strategist and a retirement strategist, I'm very concerned about the future when it comes to my clients. So I want to make certain that my clients have total control and that no one could ever dictate to them why they're going to pay taxes in retirement, how should they pay taxes in retirement, and what percentage of their income will be taxable in retirement. I want my clients and everyone on this podcast to have total control of everything that you're doing from a retirement perspective. Now, inflation, nevertheless, is also a very critical issue because inflation, as I've said before, is not tax deductible. So if inflation is at 3%, which is not the case, by the way, I know this is what you hear in the media and you read in publications and so forth, but the reason why the government shows it at a little bit just shy of 3% is because they're not including the inflationary cost of food, energy, and medical expenses and gas prices. So if you were able to include all of those into the calculation, obviously inflation in the United States would be north of 4%. Now remember, you also have a personal inflation rate. Some of us have a tendency to spend more than others. So therefore, we're all going to have to take a look at our spending habits and making certain that, we do things the right way and we don't run out of money before we run out of life. Now, another major eroding factor are loans and interest charges. And these are the interest charges that we as Americans pay for everything that we borrow. Whether it is a mortgage, whether it is credit card debt, whether it would be automobile debt, when we're financing automobiles. One of the things that I always mention to my clients is that everything in this country is financed. And the reason for that is from an economic perspective is one that is very critical to understand. But the vast majority of the clients that I engage for the first time, they know how to make money. They just don't understand how money works. And many of them say to me, well, Bert, I really don't finance everything. I pay cash for everything that I acquire in this country, because obviously they have the ability to do so. My answer is that everything is financed. Either you're paying interest to someone else, or you fail to receive interest on your money by paying cash. So if you finance an item, you're paying interest to someone else. Obviously, that may make sense, that may not make sense, and depending on what kind of rate of return you're getting on your other investments. But if you're paying cash, now you have just foregone that money, whether it's $20,000, $30,000, $100,000, whatever it may be, and now you're no longer getting any interest on that money. So when you buy an item in this country, the cost of purchasing that item is not just the amount of money that it took for you to acquire the item, but also the foregone interest rate if you paid cash, or the interest that you could have earned on that $100,000 had you invested somewhere else. And that's how economics really work. And obviously I have been studying economics now for the past 40 years, so I have a very clear understanding of how economics works from a business standpoint. So loans and interest charges are also very critical. Financial expenses. We all need to spend money on stuff that we need, whether you're paying fees to your financial advisors for money management, fees on your 401ks, fees on your IRAs, fees on your mutual funds. Perhaps you have a fee-based financial advisor that you got to pay fees to on an annual basis. So all of those things have a tendency to compound and not in your benefit. Loss opportunity cost. I just talked about it when we talked about loans and interest charges. That is one of the most misunderstood, if known, by the way, financial eroding factors that we have to us. And those we actually have the ability to control up to a certain level. If people understood the cost and the loss opportunity cost, people would make better decisions with their money and their economics as they go out into the marketplace to acquire the things that they wish to obtain. And the challenge with opportunity cost is that everything has an opportunity cost. If you buy an automobile, that has an opportunity cost. Not only is the price of the car that you purchase, but also what you could have done with a car. What if you decide to buy some term insurance? Term insurance has a very high opportunity cost. Why? Because insurance companies, when they insure you, because you may purchase a 10, 15, 20, 25, or 30-year term insurance company, when they go through their underwriting and they look at their statistics, they realize that you're pretty much making a bet. So if you buy a 20-year level term insurance policy you're betting them that they're going to die, that you're going to die within the next 20 years. The company is betting you that you're not. 97.7% of the time, and that's according to statistics, the insurance companies are going to win. So if you bought a 20-year, if you are 40 years of age and you buy a 20-year term life insurance policy, and at the end of 20 years, had you known that you were not going to die at the end of 20 years, would you have purchased that policy? The answer would have been no. You would have never purchased or put money into a product that there was a high probability that you were going to lose. One of the things that I do in my planning perspective when we do our customized retirement blueprint for our clients is we want to make certain that if our clients get what they want, it should not cost them money. And for that, I mean like term insurance policy. You know, you buy a policy for 20 years. At the end of the 20 years, you're not dead. Guess what? Your policy just went away. Your policy died before you did. And if you need to buy another 20 years of coverage, well, now you're 20 years older. You may not be as healthy. You may not be able to qualify, so you're going to have all kinds of challenges. But leaving that aside, take a look at the fact that, had you taken that premium that you were paying for those 20 years and had you put that into an account, earning 3, 4, 5, 6% rate of return, not only did you lose the cost of that term insurance, but also the opportunity of that cost because you could have invested that money somewhere else. And then on top of that, because of the fact that if you don't die in the next 20 years, you will die definitely after that. No one has ever made it alive. Now your family not only loses, and not only you and your family lose the premium that you put in and the opportunity cost on that premium, but also the death benefit, which is never received because the insurance contract died before you do. So understanding loss opportunity cost will force Americans to pay a lot more attention as to how they use their disposable dollars. Now, stock market declines and interest rate declines, those are things that are very critical, and they're opportunity costs. Obviously, we all know that the stock market usually moves most of the time north and south. Sometimes it goes west from that perspective, but 99% of the time the market goes north and south. And the timing of when the market goes south and your retirement is very critical. Because if you suffer 3 years of consecutive losses after you retire, you may reduce your retirement income by anywhere between 13 and 15 years. Now that's very, very difficult, especially at a point in time in your life where you're no longer productive and you're no longer earning an income. The same thing happens for interest rates. Back in the 90s, I had clients that retired and they had, $500,000 portfolio, $1 million portfolio. They were able to park that money in a CD at a local bank or institution and earn anywhere between 5 and 6%. So they were earning, let's say on $1 million portfolio, they were earning on the average $60,000 in a CD. Well, how much are CDs paying today? When was the last time that any of us saw a CD paying 6%? What if you cannot take any risk on that money? Now, instead of living on $60,000 a year, you may be able to live barely on $15,000, $20,000. What kind of a quality of life is that going to be to you and your family? Another major eroding factor that we discuss with our clients when it comes to retirement is what we call technological changes. Things are changing every day. And we as human beings always want the latest and the best. So the same thing, we purchase new automobiles because they have new features and benefits. We do a lot of things in our life. We buy cell phones. There are people that line up 2 or 3 days in advance when a new iPhone is coming out. Now, to me, that's crazy because you're going to be able to get it at any point in time anyways. But those are things that are costing Americans a tremendous amount of money. So you have to be very careful about technological expenses and payments that you make for different items that you may want to acquire in your life. one of the critical ones, another eroding factor, is planned obsolescence. And planned obsolescence, no one really truly thinks about. It's just like opportunity cost, and it happens around us every single day. If you're in retirement, you're 65 years of age, you and your wife own a home, well, obviously you need to maintain that property, because if you don't maintain that property within 3-4 years that go by, that property is going to be worthless. You're going to have so many more issues in dealing with the property unless you have the ability to maintain the property. Air conditioning systems can break. They need to be either repaired or replaced. Heating systems, the same thing. If you need to replace your roof, that can cost anywhere between $20,000 and $35,000, depending on the size of your home. What if some of the stuff, if you get some of the stuff in your home does start to, rot out? Refrigerators, vacuum cleaners, furniture, microwaves, things that have a finite life need to be taken into consideration, because there's only one income or one combination of income coming into the household, and you want to make certain that that income stays ahead of inflation and is giving you enough peace of mind for you to be able to deal with the other 9 eroding factors that we have talked about. The 10th and last eroding factor that I mention to my clients regularly are lawsuits. And as we all know, we live in a litigious society. I mean, in this country, you can pretty much sue a ham sandwich if you want to. The thing with lawsuits is that the vast majority of Americans are not properly protected. I'll give you one example. Most of us have vehicles, multiple vehicles. Most of us own a home or live in a home, or we lease a home. What would happen if you get involved into a car accident in which you were at fault? And let's say that you have 25-50 as far as coverage, or you have 50,000 and 100,000. Basically on your automobile policy, your property and casualty policy, when you have a policy that has 50 and 100,000 of coverage, it means that it's going to pay $50,000 in damages that you may have caused to others per person, and the maximum that it'll pay for the accident would be $100,000. So what would happen if you run a red light and you hit someone, and all of a sudden that person has major injuries? Forget if that person dies, because obviously it's going to cost a tremendous amount of money more. But what if that person becomes disabled? What if the damages, the hospital bills, and all of that to that individual exceeds your $50,000 liability limit? What are you going to do then? What if it's $500,000? Where's the other $450,000 going to come from? Well, obviously that individual is going to hire an attorney. The attorney is going to do their due diligence, and they're going to come after you. And every piece of asset that you own that is not credit protected, you might as well kiss it goodbye. So perhaps your stockbroker really did a good job for you on that mutual fund portfolio that he put together for you. Well, you might as well kiss it goodbye, because he or she did a really good job, not for you though, did a really good job for someone else, because you failed to protect your assets. So remember, protecting your assets is paramount if you want retirement success in your life. And that is something that we deal with our clients every single day. Whenever we do any type of planning, we want to make certain that the vast majority of the assets that our clients have in their name are totally protected when it comes to legal issues and concerns along the way. Warren Buffett said it best a number of years ago. He said that there are 2 principles of investments that every single American need to pay attention to. The first one is never to lose the principle of your investment. That would be rule number 1. Never lose the principle of your investment, whether it's investing in the stock market, investing in real estate, or getting sued. Never lose the principle of your investment. Rule number 2 is never to forget rule number 1. So do I need to say any more about this? I don't think so, but I am hoping that you have a clear understanding of the things that we have to deal with in order to make certain that we can prepare ourselves and our families and our surviving spouses from a catastrophe at some point in time in the future. Now, getting into Roth accounts, they follow, the Roth 401k follows more or less the same profile as we did last week with the Roth IRAs. Now, when you put money into number one, Roth 401ks are employer sponsored. Now, we still see some of the old 401ks that are available in the marketplace that have been with certain employers for a number of years, where they don't have a Roth 401k feature. So if you work for one of those employers, you may want to talk to them to see if there's a way that they can talk to human resources and see if they can reprice that 401k or add a Roth 401k feature, because usually what you find in the marketplace are traditional 401ks where the money that you put in is pre-tax, the money grows tax deferred, but then when you pull the money out, it is 100% taxable to you and to your beneficiaries. With a Roth 401k, it works a little bit different. The money that you put into a Roth 401k, the money is after tax instead of pre-tax. The money grows tax deferred, and then when you retired, it is now tax-free instead of being taxable. So those are things. Now, if you have the ability to have both in the same 401k, then if you do proper planning with a retirement strategist like myself or someone in my firm, then obviously there's going to be a calculation that we're going to do that will determine what percentage of your annual contributions to your Roth 401k should be done on a pre-tax basis, and then what percentage should be done on an after-tax basis. Now, always remember that the match that your employer makes on your 401k contributions, whether they're traditional 401k contributions or Roth 401k contributions, they are going to be pre-tax, because that way the employer can take a deduction as an employee benefit for tax purposes for the given year in which they make that contribution. Now, obviously, there are limited contribution limits to 401ks and Roth 401ks. The most that you can put in 2018 into a Roth 401k is $18,500. But if you happen to be age 50 or older, the IRS does give you a catch-up provision where you can put another $6,000 away. So if you happen to be age 50 or older, you can now contribute $24,500 to a Roth or a traditional 401k. Now, obviously you have no access to the funds in your account prior to age 59 and a half, although you do have the ability to pull out your contributions without any taxes or penalties, but the growth of your investment will suffer taxation prior to age 59 and a half and will also suffer a penalty. Now, there are minimum distribution requirements at age 70 and a half, but it's something that's very easy to take care of. So whenever my clients are getting close to retirement, we start to do a rollover of the Roth 401k to a Roth IRA, and now the Roth IRA evades that 70 and a half rule, which means that the money can stay in that account for many, many years to come past the age of 70 and a half without any minimum requirement or minimum distribution, and the money can continue to grow tax-free, and then the account holder makes the ultimate determination as to when engage or take money out of the account. One of the beautiful things about Roth 401ks is the fact that it does not trigger Social Security taxes. Now, as most of you know that we have already covered in these podcasts, there are only 3 vehicles under the IRS code that will not have a negative impact on your Social Security benefits. And those are your Roth IRAs, your Roth 401ks, which are the ones that we're talking about on this podcast, and then the 7702 plans that we talked about a couple of weeks ago. Even municipal bond funds, although they're received federal income tax-free, they do get counted against your Social Security benefits under the provisional income calculations to determine what percentage of your Social Security benefit is going to be taxed in retirement. It could be 0, it could be 50%, or it could be 85%. And obviously one of the main features of a Roth 401k is that it is also creditor protected in the United States. So again, I wanted to take a short podcast and give you a short podcast today on the features and benefits of a Roth 401k. Next week, we're going to do a really, really good podcast on how to divorce the IRS in retirement and how to do so legally. But a lot of planning will go into play if you want to be able to do that. So again, as I always say at the very end of each and every one of our podcasts, my number one job is to help you change the way that you see things. Because when you change the way that you see things, the things that you see change. So again, thank you so much for listening, and we look forward to seeing you again next week.